Hello, in this video we'll talk about earnings and profits, also known as EMP. We're going to specifically focus on corporate tax with respect to EMP. Why does it matter? Why do we use it? Why is it a measure with respect to corporate tax? Now, many of you know about EMP, you know how to calculate it, you know that it's used in corporate tax determination with respect to the shareholder. If a shareholder receives a distribution, what are the tax consequences with respect to distribution? Well, we always ask, well, how much EMP does the corporation have? Because to the extent of EMP, a distribution will be treated as a dividend. Beyond EMP, then it's considered a return of basis, and then beyond basis is a capital gain distribution. So it does affect the tax consequences. Now, before we go into the specifics of why we use EMP, I just want to go over a refresher on how to calculate EMP. I already mentioned what it's used for, but how exactly do we calculate it? So earnings and profits is a mechanism for calculating the amount of the corporation's funds that reflect corporate earnings. So really earnings and profits, which is a tax term, it really is a financial term. It's really an economic concept where we go back to the concept of retained earnings from financial accounting. So what we're doing here in the calculation is we take, because earnings and profits, EMP is a tax definition, we take tax items and we adjust them to get to financial accounting or more economic situation. So our starting point for EMP is always, and we're determining the current EMP, is always the taxable income for the current year. We add to that any receipts that are not included in the gross income. They're excluded from gross income. So an example of something like this would be something like municipal bond interest. So if you remember, municipal bond interest is tax exempt for tax purposes. But if you think about economically, if a corporation receives municipal bond interest, they own some bonds, and they receive interest in municipal bonds, do they actually economically have income? Yes, in financial accounting they do as well. So that actually increases income. And again, we're trying to get to a more economic standpoint of the earnings for the year, an economic sense of the term, not a tax sense. So we do have to add back any municipal bond interest. And this will make sense more when we talk about why we use EMP, and that will really help solidify this whole idea of not only how to calculate it, but also, again, why we use it. So that's just an example, but there's other examples out there. You know, you're thinking of things that are not included in income for tax purposes, but they should be included in income for economic purposes because economically you do have that. We also add back certain deductions that are allowed for tax purposes, but again, not allowed for economic purposes. So an example of this is the dividend received deduction, the DRD, dividend received deduction. So as many of you know, economically, you don't get a deduction or you don't get to reduce an expense on your income statement for deductions paid. You do for interest, but not deductions. I'm sorry, not for dividends. Not for dividends. But for tax purposes, certain corporations, depending on your ownership, a corporation that owns another corporation, if that corporation receives a dividend, they get a deduction up to a certain percentage based on ownership, and they can reduce their taxable income by that deduction. And this is because we don't want to have quadruple, quintuple taxation, triple, quadruple, quintuple, more than beyond or beyond double taxation. So it's a way to relieve that, and that's how Congress put that in place. Well, again, for financial accounting purposes, there is no such deduction. Economically, there's no such deduction. It doesn't reduce your income. Okay, a dividend, we're going to see economically and financially comes out of, it does not come out of your income. It comes out of your statement of stockholders' equity section of the financial accounting. Okay, so that's an example of something we have to add back that's deductible for tax purposes, but not deductible for financial accounting purposes. Now we subtract from taxable income certain non-deductible items for tax purposes. So we're saying that for certain deductions that are allowed for financial accounting purposes, but not allowed for tax purposes. So some examples of this, perfect example is federal income tax paid. So federal income tax. On an income statement, you'll always see federal income tax expense, which is reduced. But as we know on the federal taxable income calculation, you can't subtract away federal income tax paid. That is not a deduction, but it is for financial accounting purposes. So we have to reduce that because, again, our end number, the current year EMP, remember EMP is going to end up being a financial accounting or an economic indicator, not a tax indicator. We're starting with tax numbers, though, because, again, EMP is a tax definition. So financial accounting or economic concept. Financial accounting or economic concept. Finally, we add or subtract timing differences. And what I mean by timing differences, we're talking about things that are recovered, either they're included in income over a different period of time with respect to tax versus book or financial accounting, or deductions. You take them over different times. But in total, you'll see it's going to be the same amount. So a perfect example of this is depreciation. As many of you know, in tax we use MACRS, Modified Accelerated Cost Recovery System. And many of the assets under MACRS are depreciated under a double declining balance system. But for financial accounting purposes, most businesses use straight line. Well, as we know, in total, the same amount of depreciation will be taken straight line or double declining balance. However, double declining balance, as the name suggests, is going to depreciate faster early on and less later on, versus straight line is the same over that amount, okay, each year. But again, if you're looking at a 5-year asset, you're still going to depreciate the same amount over the entire life. It's not like, in financial accounting, you're going to depreciate more or less in total. You're going to depreciate the same in total. It's just a timing difference, how much you take each year, but in total, it's the same amount. So that's an example of a timing difference. So timing differences are always the most tricky because you have to look year to year, because if you're doing depreciation, some years you'll be adding, some years you'll be subtracting, but that's only if you have just one asset. If you have other assets, you have to look into the total of the assets. So see how that works? That gives us, from taxable income, those adjustments, that gives us our current year EMP, which is a financial accounting and it's more economically based. Okay. Now, another way to think about current year, or another way to think about EMP is it's a term in financial accounting we call retained earnings. Retained earnings and EMP are almost always going to be the same. Retained earnings is a financial accounting term or phrase. EMP is a tax term or phrase, but really they are the same thing. So if you're taking the CPA exam or an exam and you're not given EMP in a corporate tax sense, but you are given retained earnings, you can use retained earnings as a pretty good estimate of what the EMP is with respect to that taxpayer, just so you know. Okay. Now that we know we went through a refresher on how to calculate EMP, and again, I want to reiterate that EMP is current year EMP and also accumulated EMP, okay, is used, again, in corporate tax land when we look at the tax consequences of a distribution received by a shareholder. What exactly are the consequences going to be to the shareholder? And again, if there's enough EMP, it'll be treated as a dividend. If there's not enough EMP, then what we do is it's going to be a return of capital basis, the basis in the stock, and then beyond the basis in the stock, it's capital gain distribution. So it does make a huge tax difference. It does make a huge tax difference, especially when you look at the history, which I'll talk about later, the history of dividends versus capital gain distributions. Now, I want to mention again, this is just a refresher, EMP is a rolling concept. EMP is a rolling concept. So we determine EMP for the current year, but EMP goes into a accumulated EMP, which is really the true EMP. Earnings and profits is a rolling concept. It rolls over from year to year to year. So when a business forms, when a corporation forms, on formation, immediately at formation, EMP equals 0. EMP is always 0 on formation, okay, of a business. Unless there was some type of merger or some type of merger with respect to a reorganization a reorganization event, then EMP might roll over. But if you're simply forming a corporation from ground up, beginning it, EMP is going to be 0. So knowing that, let's take a look more at the retained earnings concept. Because I mentioned that EMP is a tax term, but it's taking taxable income and getting it to a financial accounting term. And you're wondering, well, why don't we just use retained earnings? Well, again, it's not always the same. It usually is depending on the taxpayer. But again, you always have to use EMP for the determination. There can be some subtle differences out there. Now, I want to look at retained earnings in the financial accounting sense because that will help us understand why we use EMP for tax purposes to make these determinations. Why don't we use some other type of item? So to understand EMP, we have to understand financial accounting. And for many of you out there, you might have some basic understanding, but if not, I'm going to talk about it very basically, and I'll give you a little, I'll make sure you understand. So financial accounting is all about, reporting the financial information of the company. And when you look at the financial statements, assets equals liabilities plus stockholders' equity. That is the accounting definition, and that's what's used for the financial statements with respect to reporting the information with respect to a corporation. Now, stockholders' equity, SE, which is also known as owner's equity if you're not a corporation, if you're some other type of business entity like a partnership or a sole proprietorship, stockholders' equity is broken into 2 parts. Stockholders' equity is broken into retained earnings, RE, and paid in capital. Paid in capital. Now, paid in capital deals with the amounts of capital contributions and those kind of determinations, treasury stock, with respect to the corporation. Retained earnings, though, is where we have net income or net loss that rolls over year to year, and we subtract away our dividends. So dividends come out of retained earnings. Now that's why EMP, which is again very similar to retained earnings, that's why we have to use EMP, is because it's just like retained earnings, and retained earnings is where dividends come from. And that, again, it rolls over, and we have to keep track of that balance. Now, paid in capital, again, is where you would have any capital that's contributed, whether it's paying for stock, contributing assets for stock, or whatnot. That goes into those accounts. And again, there's also treasury stock. But really, the main thing is that capital that's contributed to the corporation, it goes into that account. Okay? Now, I mentioned that on formation of a business, EMP will be 0, and that's because there haven't been any net income or net loss or dividends. So going forward now, if I use the term EMP and retained earnings, just assume that they are equal with respect to this, what we're about to talk about, why we use EMP. So if I use EMP, I'm referring to retained earnings for financial statement purpose. If I'm using retained earnings for financial accounting purpose, I'm also referring to EMP for tax purpose, because you're going to see it's going to have the same general understanding. So that's retained earnings, and that's paid in capital with respect to the financial statements. Okay? Again, retained earnings from a tax sense has a very similar idea because it also rolls over. Retained earnings rolls over year to year to year. You have to do this calculation each year, and it rolls over and keeps track of an accumulated balance. So retained earnings can be negative. And if it's negative, you can't pay out dividends. Okay? You can't pay out dividends. All right? If retained earnings is negative and a distribution is made, it's really viewed to come out of paid in capital if you think about it. Why? I'll give you an example. So if retained earnings is negative, it's really viewed to come out of paid in capital, okay? So let's say that we have a corporate formation, which the EMP and the retained earnings will also be 0 for the business. And let's say let's say that the business, it's going to receive cash contributions, all cash, from the owners. Now, let's say that business, it also, let's say a few days after the business, it's going to buy some assets, and then a few days after that, it's going to distribute out an asset to one of the owners. Well, let's just assume for this problem it's been a few days after formation, just a few days, and again, there's no retained earnings or earnings and profits. Those are 0 because let's just say the business hasn't earned anything yet. All right, but there's been a distribution. Well, if you think about it economically, where is that money coming from? If there haven't been any earnings, but a distribution's been made, where is that coming from? Well, retained earnings, there's nothing here. But there is some money over here in paid in capital. So that means the distribution has to be coming technically, economically from this side of the picture because, again, there's nothing over here. And let's say that, okay, yeah, we have assets and liabilities, and those are going down, but for those of you who know the accounting equation, what goes up on one side must go down or must be the same on the other side. So if you're distributing an asset out, that means, to a shareholder, assets go down, and let's say this business doesn't have any liabilities, well, stockholders' equity has to also go down. So paid in capital will go down. So that's the idea. It would either have to come from retained earnings or paid in capital. Okay. Now, yes, you can reduce it with the sense that retained earnings could be negative. However, from an economic sense, again, it makes more sense that this comes from the paid in capital. So continue with that same idea. Now let's take a more realistic situation. Let's say that a business, it forms, right? And on formation, again, EMP is 0 on formation. And then let's say the first year, there's a net loss. So year 1, let's say the business has a net loss. In year 2, the business also has a net loss. So after year 2, retained earnings is negative. Because again, you keep track of this as a running tally. It rolls over year to year, right? Year 1, retained earnings would be net loss. Year 2, it'd also be even increased net negative because you would have to roll over, right? Net loss plus net loss gives us even bigger negative. But let's say in year 2, at the end of year 2, the corporation decides to make a distribution. This is more likely. Well, where is that money coming from? Because again, nothing has been earned here. Well, again, it would have to come from this side because, again, on formation, there's been cash that's been contributed, and there's cash in the business as an asset, right? Maybe it's been used in the formation. Let's say there's still some cash left over at the end of year 2 because the amount contributed was just so high, okay? Let's say they contributed $1 million on formation, and the business so far in year 1 and year 2 has used $100,000. There's $900,000 cash left over as of year 2, okay? As of year 2. So in the business, there's money in the business. There's $900,000 in cash. Yes, $100,000 has come out. That's through the losses and whatnot. And they haven't earned any income yet, or net income yet, to help with that situation, retained earnings. So the issue becomes, if there is a distribution, let's say there's a $10,000 distribution, how can any of that distribution be classified as coming from this side? There's nothing over here. Paid in capital, though, if you're paying out $10,000 and there's nothing over here, it's viewed as if it's coming from the cash that's originally contributed, right? As if a withdrawal of the contributed funds. So that's what's going on here economically, if you think about it. Again, because there's not been anything earned. It's been net loss, net loss. We've been losing money, if anything. That cash that we started with has just been losing money. Okay, assume to keep the example simple, is that let's say his business, all they do is they operate with cash. They lease out stuff. They buy inventory with cash. They don't have anything on account or anything like that. All they have is cash as an asset, and then they don't have any liabilities. They've lost $100,000 cash because because their business operations haven't been doing well. And let's just say they haven't earned anything yet, any money yet, but they do make a distribution at the end of year 2 of $10,000. Well, it's economically coming from the only cash they have is from this capital contributed on formation. So that brings into a question. So that's from a financial accounting standpoint. But if you're addressing that from a tax standpoint, the question becomes: should that withdrawal of the contributed funds, this indirect? This is an indirect, right? It's indirectly a withdrawal of the contributed funds. Should that, from a tax standpoint, should that be taxed as if it's income? And I would say no, it shouldn't be. It shouldn't be taxed as income because it's just like the idea of contributed capital. And taking that money out. You'd be double taxing the already existing capital. And in tax, through the basis concept, we know that that's not really allowed. So if we have a negative situation here in the retained earnings, which again, EMP would be the same treatment because that's very similar. And then but we do have a distribution of cash, then again, it's as if it's coming from the contributed capital cash, right? And again, why should we tax that? It's already been taxed. Now, if someone contributes an asset to the business, and the business, other than cash, and the business 2 years later distributes out that asset, and let's say they distribute it back to the original owner, and let's say there's been an increase in value, then perhaps that results in a gain over what was previously contributed, the basis of that already. And that makes sense from a tax standpoint. That works in our tax principles. But again, if it's just cash and it's being distributed out and there's not been any earnings, why should that be taxed? That makes no sense whatsoever. All right, so I hope that example right there helped you understand some of the purpose of what's going on. Just to summarize, again, the idea is that, as many of you know, we use EMP to determine, when we have a distribution for tax purposes, what portion is going to be considered dividend and what portion is going to be considered return of capital. And that's kind of the idea. Again, if a business, just think about it from a simple sense, many businesses, they start off operating at losses, and if a distribution occurs, while the business is still operating in losses from existence, why should that be viewed as all taxable, the full amount, when really economically, if you think about it, it's just recovery of the capital that's been contributed by the business. Now, again, if there's been some gain that's been earned on some property, then yeah, that should be taxed, but not the full amount. Because again, if it's coming from capital that's already been existing, why should we double tax capital that someone contributed? It's just like if you buy land, you pay $100,000 for land, and then you sell it a year later for $150,000. You don't pay tax on $150,000. You pay tax on the gain on the land because, again, of the tax principle that you already put in this capital, this $100,000 amount. That's your investment. And why should you pay tax on investment? That's technically not income. Again, because again, in tax, we tax income. We don't tax the whole amount. All right, so if you're still having a little bit of trouble understanding, that gives you a one sense. Another thing I want to talk about is, as many of you know, dividends at one time, or historically I should say, dividends have been taxed historically as ordinary. Now, at the time of this video, and for many years prior to the video, there's been special rates, long-term capital gains rates on most dividends, unqualified dividends. So really, a dividend at the time of this video is taxed the same as a capital gain distribution, a long-term capital gain distribution. All right, just so you know. So really, the sting of the issue of using EMP to determine whether something is a dividend or a capital gain distribution, that sting is not as big at the time of this video because, again, they're taxed at the same rates. All right. Now, it does make a difference because if you are considered return of capital, you're beyond retained earnings, you're not going to be taxed at all, dividend or capital gain distribution, and that's a very important thing there. Okay. But if you think about it historically, dividends, they're taxed as ordinary income. Okay. Now, if you think about a business that's earning net income or net loss, let's just assume that we are a sole proprietorship. And remember, I mentioned that a sole proprietorship, the accounting equation is not assets equal liability plus stockholders' equity. It's assets equal liability plus owner's equity. Now, owner's equity is not broken into retained earnings and paid in capital. Owner's equity is just owner's equity. And owner's equity, we have net income and net loss. They go into that, and they again roll over each year. Owner's equity is calculated every year. We also have contributions and withdrawals. So those things are what go into owner's equity. Now, if for tax purposes, if a sole proprietorship, if it earns money, it has net income in the business during a year, well, for tax consequences, and let's say that all that net income came from normal sales. Let's say we have a normal retailer, a normal retailer, just a retail business, and all the income comes from sales, which we know is sales income is going to be ordinary income. So there's no special capital gains or 1231, anything like that. All the income from the business is from sales. There's some cost of goods sold, and then that gives us net income. So that net income is going to be taxed on Schedule C and flow over, it's going to flow onto Schedule C and then the 1040 of the owner, of the sole proprietor, and it's going to be taxed as ordinary income. That net income will be taxed as ordinary. Now the key is that is net income. That is net income, and it's taxed as ordinary. So think about a corporation. Now go back to our corporate tax sense. If the corporation is earning net income or net loss, okay? Yes, we know the corporation pays tax. Corporations have their own tax rate, and it doesn't differentiate between the characterization, as we know. Ordinary versus capital has the same rate, okay? But you still have to understand that corporations at the corporate tax level, right? We have the corporate tax level. That's level number 1. And then when we have a distribution, the owner pays tax. That's where we get our double taxation. That's where we get our double taxation. So when the net income, so take this retail example, and let's say instead of being a sole proprietorship, it's now a corporation. Same owner, but a corporation. The corporation has to pay tax that year on the net income, but does the owner have to pay tax? Not until a distribution is made, because it's a separate legal entity, and that's where we get our double taxation. That's where we get our double taxation. Now, if the distribution is viewed as coming out of the net income, shouldn't it be taxed just like the sole proprietor as ordinary? Yes. And that's why dividends are treated as ordinary income. That's why dividends are treated as ordinary income, because it's viewed as them coming out of net income or net loss of the business. Net income or net loss, not the paid-in capital section. If it's coming out of paid-in capital, then it should be able to recover basis. And that's exactly what the rules are, as many of you know. If you do not know, I have another video that deals with the the tax consequences with respect to corporate distributions. Please watch that. And when you get to step 3, you'll see that what we do is, when we're determining the tax consequences of the shareholder, we first say, how much EMP do we have? Okay? Well, first we have to determine, is it a property or cash or property distribution, not a stock distribution. Once we determine it's a cash or property distribution, then we ask how much EMP. Because to the extent of EMP, that's how much is considered a dividend. So that is, this over here is taxed as ordinary. Whatever is considered out of retained earnings or EMP is taxed as ordinary, because again, that's how the sole proprietor would have been taxed on it. Net income flowing over. Net income flowing over, right? The dividends, which are taxed as ordinary income, historically, dividends have been taxed as ordinary income, just like the net income in our example. Just like the net income. Now again, right now the video is a special rate, but hold that aside. Historically, ordinary income. Same result as the sole proprietorship, where again it would flow over as ordinary income, that net income from the sale of the retail items. And again, if we have a corporation and distributions made, we look at how much retained earnings, because to the extent of retained earnings, that amount is going to be treated as dividends, which again historically has been viewed as ordinary, which again is the same treatment. If there is no retained earnings, then it's like my previous example where it was just nothing but net losses, and it came out of the paid-in capital, which again, you shouldn't be taxed on the amount you put in. It's recovery of basis. So that's why we use EMP, which again is a similar concept to retained earnings. So I hope that this helps you understand what's going on. Again, it helps you understand by thinking of the 2 examples. What happens if we have net losses in the early years of a business and the distributions made? Should somebody have to pay tax on that full amount? And if so, should it be treated as ordinary? And the answer is no. Okay? It should be a recovery of basis. Again, the retained earnings is ordinary on the full amount, because it's just like the net income. On the full amount, because it's just like the net income from our sole proprietor. So example 1 was our net loss example. Example 2 is, what if you have a sole proprietor and they make money and that money flows to them? Well, it's been taxed as ordinary, normal retailer. And then you take that same situation, and what if you just said, okay, instead of a sole proprietorship, that owner is now a corporation. Again, corporation pays tax once the income is earned, but once the distribution takes place, again, because there's this net income concept, it should be taxed as ordinary in the full amount because it came from the net income. Because again, the rules on corporate distributions are viewed that it first comes out of net income and then comes out of whatever's left paid in capital. It's an ordering rule. That's how it works. So I hope this helps you understand that's really why we use EMP. Not a lot of instructors out there, they explain why we use EMP, and I've kind of, when I learned about EMP the first time, it really helped to understand, again, financial accounting, and then using the two examples, the net loss example and then the sole proprietor. So I really hope that this helps you in your understanding.